I'm not in a good mood. How could I possibly be in a good mood if I'm going to lose 20 grand a month, $250,000 a year? Go on, fly away, baby. We got to be big shots and go into retail. Well, now we're going to take our licks. It just slapped us. So we have to figure out what the hell we're going to do. Hey, we're going to offer a reward. I will give anybody $20,000 reward that leads to me or him or us renting out this space. Banner right there, a banner, a nice one, permitted and all that, professional, that says,
now leasing.
Welcome back, my passive income investors. Like if you can run out there in these weird pandemic times and find Ben Malla a tenant, he's going to give you 20 grand, which just shows you how hard everyone is starting to feel the effects of this virus. But more importantly, today, I want to show you how you're going to make a lot of money because something happened historically that hasn't happened in a decade. And we're talking about the slaughtering of real estate investment trusts. Now, I've been buying some REITs, and this year I said I was primarily going to be focused on REITs, and now my doors are wide open because we're going to be analyzing not only my 3 top favorite REITs that I'm personally going to be purchasing, we're going to take a look at the broader sector of REITs and just show you how bad this really is. So ladies, gentlemen, I look so forward to breaking this down for you. So let's jump right into this.
Drop it.
Welcome back, my passive income investors. We have got to talk about something here. I've never seen anything like this in my entire investment career, which has been over the last 5 years. So, I got a ways to go still. But what if I told you here in Canada, I was selling a portfolio of real estate, and this portfolio had real estate in Toronto, Ottawa, Calgary, Montreal, Edmonton, Vancouver, and the top 30% of the tenants renting that real estate were Canadian Tire, Loblaws, TJX, Cineplex, not my favorite, by the way, Metro, Walmart, Montana's, Harvey's, Swiss Chalet, and Kelsey's, Sobeys, Dollarama, and Lowe's. What if I told you could have all of this, but right now, 50% off? Well, that is the reality we are currently facing in this pandemic as real estate finally takes the plunge. And we're not just talking about your everyday kind of stock market volatility plunge. We're talking about 2008 financial crisis type plunge. And in my humble opinion, I don't think it is well deserved considering we are not in a financial bubble, a financial crunch here. People are going to have issues. They might have issues paying some of their rents. And obviously some people might have troubles paying their mortgages. But at the same time, the REITs I'm showing you today are REITs that I am personally buying right now. And we're starting all of this off with RioCan, which is one of my favorite REITs that I have been loading the boat on. Clearly, I should have waited because the stock is down a whopping 43%. At the lows, it was down more than 50% with currently a 9.4% dividend yield and a PE of 6. But if we're buying these in a pandemic, we want to know we're going to get paid. And are these companies we're going to look at capable of paying their dividends? Well, starting with RioCan here, its payout ratio is at 0.6 times. And if we go into the balance sheet, the thing that I always tell you guys to look at is total assets versus liabilities. With 14 billion in assets and 6 billion in liabilities, that gives us almost a $7-8 billion underlying asset value for this company. And if you don't know RioCan, I've mentioned it before, guys, they deal with new development. They do everything from malls to literally just rental apartments, new construction builds, all kinds of fun stuff going on in the greater Toronto and Canada area. And this is the primo of the primo for real estate, in my personal opinion. And if we take a look at the dividend history, guys, going all the way back to 1998, being through 3 financial crises leading up till this one, we've gone from a dividend yield of 95 cents annually all the way to a dividend yield of $1.44. And obviously in 2020, it looks like the dividend is junk, but that's just because it's adding up the monthly payouts as they get distributed. So looking for real estate deals, guys, this is just unfathomable. Taking a look at our second REIT here, All Realty Income, which right now is at the top of my list when I get some capital to buy a stock. Very volatile, up 12%. It hit a low of about $42.50 a share. Taking a look at the history of this company, we are looking at lows that aren't like the 2008 bubble we're seeing on RioCan in Canada here, considering this is a U.S. REIT with a 6% 6% dividend yield. We're talking about a PE ratio of 33, which is not accurate on this stock. I know that for sure. But still, overall, guys, let's take a look. Can it afford to last through all of this? The payout ratio a little bit higher than RioCan at 0.8 times, pushing up to getting to levels that might get a little sketchy. But let's take a look at that underlying balance sheet, shall we? With a total asset value of $18 billion, minusing those total liabilities of $8 billion, well, that gives you about $10 billion in underlying assets. And taking a look at Realty Income, if you've never heard of the stock, world renowned, paying dividends for something like 50 years, increasing them every single year with strong shareholder returns of 596 consecutive monthly dividend payments. That's unbelievably, with 90 consecutive quarterly increases. So this company has been on a tear. And taking a look at some of the real estate in and of itself, guys, their 20 top tenants are Walgreens, 7-Eleven, Dollar General, FedEx, Dollar Tree, LA Fitness, AMC Theaters. The theaters are the ones that I don't like. We got cinemas. We got Walmart in here again, Lifetime Fitness, Circle K. Now, these are the kind of, like, even Kroger. These are all the companies that we're seeing sell out of stock in this pandemic, like Walgreens, guys, Dollar General. Like, these are just phenomenal companies. FedEx is still delivering during all of this. These are some world-renowned REITs trading at absolutely absurd discounts. When was the last time do you think this company, Realty Income, was paying out a 6% yield? Well, actually, in its history, guys, never. In the most recent decade history, never in the history of Realty Income since 2011 has it been paying out a 6% yield. In fact, going from 2011, it was paying 14 cents a quarter all the way up till today here, guys. Taking a look at the yield is at 0.22 cents. So, I mean, the dividend yield has actually almost doubled here. Not quite doubled, but we're getting up there. And to get a 6% yield starting is never ever happened in the last 10 years here. This is a historical what is happening to REITs. And again, we're not talking about a financial crisis. Moving into another one of my favorite REITs of all time, a very unusual REIT. We're talking about GEO Group, my prison REIT, paying out a current yield of 16.8%. PE ratio on it is 8. Again, probably a little inaccurate. And taking a look at this company, guys, its payout ratio is at 0.7 times. So we're actually looking at a lower payout than we're seeing on Realty Income. So that's kind of a weird thing to take a look at, that, you know, this prison REIT is actually has a way higher yield and a way lower payout ratio. Now, it's just showing you how much of their income they're paying out. For instance, if this said 1 times, that means that they'd be paying out 100% of their income. Anything over 1 times, you have to be worried about, because that means they're paying more than they're making. But this REIT actually has a lot of room to level themselves out in case they have any kind of income fluctuations, which I'm going to get into in a second. But taking a look at the assets versus liabilities here, with $4 billion in underlying assets, with total liabilities of $3.3 billion, minus that out, we've got about $1 billion in underlying assets. And this REIT currently trades at a value of $1.38 billion. So it is trading equal to almost its underlying assets. Taking a look at something else, if you guys don't know this, suggest you take a look at it. They don't just deal with high-end, like, lifetime prisoners, though they do. They also deal with mentally ill, troubled children. It's a very diversified REIT that's been under an incredible amount of fire and is primarily politically driven, just due to the fact that, the ICE, which is run by the government, mandates and kind of shows how these companies operate. And it really depends on who's getting elected into office. But if you can handle the volatility of this company, you're going to get a global exposure. We're talking about Africa, Australia here. We're talking about, in Europe and all over the US. This is a well diversified REIT. And the problem with it, and the reason people get scared of it, is the volatility of it. Obviously, this is a stomach holder if you're going to be buying this stock, considering taking a look at their dividend history here, guys. They also, since 2012, have never paid out a dividend yield anywhere near close to this high. And if we take a look, it has been all over the place. The dividend yield's gone from 20 cents all the way up to 70 cents, all the way back down to 48 cents. Very, very volatile, but always sustains a dividend yield of well over 5%, usually in the upper range, hitting close to 10%. And again, that is primarily due to the fluctuations in what the government's paying them, what they're allowing them to do. Highly politically driven, but again, sustainable year-over-year dividends. In fact, the stock has grown substantially over the last year, and it isn't experiencing what it did in 2008 here, considering the stock dropped all the way down to $7 a share, which we're not experiencing right now. But could we? Perhaps the stock price could keep falling. But man, oh man, a 16% yield, guys. Absolutely unbelievable. So, and if I can throw in some honorable mentions here as well, guys, we're talking about Wynn Resorts taking a massive decline in the last couple weeks here, being down 68% with an 8% yield. We got MGM Resorts being down a huge amount, 75% down. Iron Mountain down from its recent high there of about 26%. And if you've never heard of Iron Mountain, they're kind of like a storage facility for high-end art and all kinds of different stuff. Taking a look at TNT here, guys, a true Canadian North, the commercial REIT that primarily deals with commercial companies, everything from government tenants. I've looked at their rentals, and they got incredible tenants with a pretty broad spectrum. And this REIT right now is down unbelievably. Actually, it's down more than it's ever been in its entire history since going all the way back to 2012, with a dividend yield currently at 13. But guys, when we're talking about REITs trading at 2008 levels as though they're going to be losing their entire company and they're under the circumstances of going bankrupt, is just not the reality of today. So why are they trading here? Well, it is just fear, and it is opening my doors up to some of the best buying opportunities in history. Literally in current historical times, this has never happened for these companies, and they're not tiny companies, guys. We're talking about billions of dollars in underlying assets that you are now going to be picking up for 30, 40, 50, some of these companies even at 60% discounts, though I do only recommend the stocks that I am personally holding, talking about RioCan, Realty Income, and if you can handle the systemic risk, we're talking about GEO Group. But the rest of these companies, well, they're getting hit a little bit harder, and they aren't trading at multiples similar to the security of something like a RioCan or an Realty Income. So I'm not going to suggest that you go out right now and just be buying all of these, but do some homework, do some due diligence, find these super solid companies and take some opportunities here, guys, because you're going to be coming back to this video, I promise you, in a year or two being like, damn, I wish I bought the dip. But anyways, I hope you enjoyed this video. I'd love to know what you think. What REITs are you holding? Are you experiencing this crazy downslide and you're already holding some of these REITs like I am? If you're a holder of the REITs, do what I'm doing. I set everything up on a drip. But I look so forward to talking to you guys tomorrow, where I'll actually break down my six-figure portfolio, which is still seeing further declines in these weird economic times. So stay cool, stay awesome, and I look forward to chatting to you tomorrow.